Hello, everybody. Thanks for tuning in. It's January 9th, 2019, already 9 days into the new year. Wow. Happy New Year one last time from my side. I want to chime in here in a video format. As you might recall or have read, we've suspended our other publication efforts pending the big reset, which will allow us to carry forward efforts without financial considerations. But what I mentioned in at least one or two past videos is that I'd like to chime in with a look under the ROE hood, specifically what comprises the ROE, the components. It's called ROE decomposition, and that is going to be very important as we take a look at earnings power, profits, much less profit growth, if you will. EPS or EPS growth is ultimately highly impacted by this. And I'd like to walk through the main pillars of this exercise. I see large secular pressures on each one of them, that the cyclical downdraft or recession will deepen, but we're looking, or I think there's a lot of reasons why, which I want to share briefly here, why all three of these pillars that determine the return on equity, which in turn determines the profit, is your multiply return on equity times the equity, the average equity that's invested in a business to yield your profit, right? And I think the pillars that will be under pressure will make sense to you as I go through them, and that they are as follows. And as I walk through this, I'm going to do my level-headed best to, or level best to display some of these slides here, hold them up to the camera, and hopefully that will be of some use. How is return on equity comprised? Well, as you likely know, it's the net margin times asset turnover times financial leverage. The net margin is the net, or the net income, called the net divided by sales. The asset turnover are sales divided by the assets that the business has, in other words, the balance sheet total. And the financial leverage is the total assets divided by equity. How much leverage, how much external financing does the balance sheet have, the business have? Those three pillars determine, when multiplied times each other, the return on equity. And as I look at this, I'm going to try to put this in a bigger picture context, specifically the Standard & Poor's 500 and its earnings power. Obviously, this is equally applicable to an individual company. In fact, that's basically where it comes from. But we're looking top down here, looking for the forest, and hope not to get lost in the trees as I go through this, to make a bigger point that we are probably in a position where a 50% plus downdraft in ROE, or earnings, profits, earnings per share, is a very good bet. Both recession-induced, which could pull it down even more significantly, both ROE and profits, and also due to secular reasons, those being probably familiar to you. The leading, the dog in the race, in the drag race here, is the unbelievable global debt and domestic debt. Global debt more than 3 times global GDP. Domestic debt at almost 70 trillion, over 3 times US GDP, well over. We've got ugly things such as reduction in property right protections, increase in regulatory, tax, and litigation insanity, and in the property right arena, whether it's through cronyism, redistributionism, the third world amnesty. The makers are being taken to the woodshed that aren't benefiting from the crony status quo. So we've got a lot of moving parts, and they tend to be negative. And yes, this perspective will be U.S. centric, but I think it applies largely throughout the world because, frankly, in many ways, we have a similar disease from that I call loosely our toxic public policy stew. So, without further ado, let me get to some examples and try to hold up some slides and give you a sense of where we are and where I think we're going to be going on ROE decomposition. This example here is a net margin of 7%. That's 0.07. In other words, $7 in net earnings for $100 in sales, and then we take those sales and divide them by the assets in the business to get asset turnover. The less assets you need to generate sales, the better off you are. I'll touch on outsourcing benefits and things like that going forward in this presentation or in this video. So we have a net margin, in this case 0.07 or 7%. We've got an average asset turnover ratio of about 0.71. And we've got financial leverage of almost 2.9 times. That is the balance sheet of the assets divided by equity. And this yields an ROE currently, corporate America, of roughly 14.3%. What I try to do here and elsewhere is to go to solid sources in terms of margins and turns and all these other concepts. And for example, the margin comes from the Stern School in New York, the Stern School of Business, and they've canvassed 7,000 public companies and come up with that kind of a net margin for last year. So I think what I'm looking at here gives you a top-down picture of ROE, that is for corporate America, or in this case, Standard & Poor's 500 companies as the leading index in the US and arguably in the world. Now, the secular pressure that I foresee on net margin, on asset turnover, and on financial leverage should, as stated, exert material pressure on the ROE, which these three things multiplied together comprise: net margin times asset turns times financial leverage, and as a result make investors hit the potential valuation air pocket, that is, those that are holding expensive, still dear stocks, notwithstanding the recent correction, and have bought them at high prices, not 30, 40 years ago or 20 years ago, but at high prices. That is my definition of capital at risk. Right. Let me shift to the first pillar, net margin. And let me take a bit of liberty here, license, when I do so. And the net margin here, I'm loosely comparing with the corporate income as a percent of gross domestic income in the United States. And corporate income is, as you might guess, materially determined by the margin, which in turn is one of the three components of the return on equity, which, by the way, has the most bounce to it, the most fluctuation, and thus can pull down and pull up equity, return on equity, much more so or more quickly than the other two. But where I'm going with this is that in the United States, corporate income as a percent of gross domestic income, which, by the way, is equivalent of GDP, all right? It's in two different ways of looking at GDP. So if you don't have a comfort level with GDI, just pretend it's GDP. What's the difference? Well, GDP, or gross domestic product, is the net value of all the services and goods produced by an economy, and the gross domestic income are the wages, interest paid, and profits that result from GDP or economic output, right? What we'll see here shortly, or I'll show you, is that corporate income as a percent of total domestic income, gross domestic income, has been going up for some 50 years. And that is to a large degree related to margins, net margins, which have been expanding. And those net margins have expanded thanks to, in the main, labor getting a smaller slice of gross domestic income, and corporations, that is shareholders, getting a bigger one. It's also been due to constructive materials cost trends and interest costs that have gone down with a 37-year bull market in bonds. And I'm suggesting that corporate margins or corporate income has peaked, both because the main determinants, labor costs, materials costs, and interest costs are set to do a 180, and not just a cyclical one, but I'm going to argue a secular turn. Now, why higher labor costs? Why higher materials costs? Well, a lot of it is because so much has been outsourced, and materials have been in a semi-depression as financial assets have ballooned. That's where the money printing has gone, specifically into financial assets, not into real assets. I think that's going to change, and we'll set forth a manifestation of a higher multiplier, and all this money that's been printed at the global balance, central bank balance sheet level will find its way into money supply. And then we've got too much money chasing too few services and goods, otherwise known as inflation. But I'm getting ahead of myself. Net margin is set, and by extension, corporate income or shareholder profits is set to reverse, because labor cannot forever have a smaller piece of the gross domestic income, because you can't continue to forever outsource the lower cost regions of the world, such as Mexico and China, and or because the dollar is going to at some point reflect the fact that the U.S. is the absolute antithesis of a free cash flow nation. It requires 600 to 700 billion in net external financing, borrows just at the federal level over 1 trillion. Corporate borrowing is also off the charts. So the U.S. is an enterprise, if you will, which requires a lot of external financing with diminishing returns. And that external financing will, combined with over $8.4 trillion in net debt overseas, ultimately discourage the rest of the world from accumulating more dollar assets. It's certainly not at current interest rates, and certainly not at the rate that would be necessary to sustain them, especially given what the Fed's doing with QT and a progressively larger deficit that the federal government is running. But this net margin, which I'm loosely correlating here to corporate income as a percent of GDI. Let me show you this chart. It has the corporate profits have been arcing up for almost 50 years, right, as a percent of GDI. And again, as we shift to higher labor costs, whether outsourcing becomes more expensive due to a weaker dollar, or increasing strength in those other economies, or labor shortages in China, or what have you, or bringing it back home, bringing production back home, obviously will also entail more expensive production, especially given America's lack of capital spending and the focus on stock buybacks, when the discouraging aspects of saving in the first place, given that creditors have been shafted and debtors have been lifted high, which shareholders have benefited from because they've been able to buy back stock, but I'll get into that one. So if we take a look at this chart here, this net margin, or the net income of corporations, an uptrend as a percent of gross domestic income, or GDP, is going to turn, and it has to also turn not only for societal equity reasons, not only for the economic reasons that I mentioned, but also, I think, increasingly for political reasons, because a large portion of the working population in this country can no longer stay in the game without adding debt, and they've added debt at a record level, and the total system, and also the equity and the politicians that will be brought in, it will be increasingly socialist, as the current wave of tax reductions and corporate repatriations at lower tax rates doesn't work, because we in essence haven't gotten rid of the very toxic public policy stew that will require sustained money printing to forestall a collapse. All right, but in terms of the other side of that corporate income and its growth as in the percentage of GDI, and that being a marker, for, if you will, for net margins rising, take a look here at the other side of this. And the other side is employee compensation. This is courtesy of the Fred rather, which is a Federal Reserve or Federal Reserve Board internet site. You see employee compensation also over that 50-year plus period heading way down. Employee compensation as a part of gross domestic income, which again is a surrogate for gross domestic product. It's not sustainable. Now, if I've somewhat convinced you that net margins are susceptible to declining because of a shift in gross domestic income pie going more towards employees, more towards government in terms of us having these huge deficits that probably can only be stuffed by taxing more, unfortunately, which will lead to even more deficits, but that's beside the point. What we have is a situation where net margins are going to head south, secular basis, and I think asset turnover will as well. Let me show you a chart on that, and the chart is right here, and the chart is courtesy of KL Capital, and what this chart shows is the asset turnover ratio, that is sales divided by the assets required, that is heading south across the board in the three main geographies or economic blocks that they cover here. And those blocks are the Americas, the developed markets in the Americas. That's that deep blue line that's already going south. The red is EMEA, Europe, Middle East, Africa. The developed markets in that economic block is basically Western Europe, obviously. And then you've got the developed markets in Asia, which in essence is Japan, South Korea, Singapore, countries like that. But what we see here is a downtrend already in the asset turnover ratio. Again, the less assets you need to produce a dollar of sales, the bigger the lift for the return on equity. That's that second peer, the second determining pillar, if you will, on return on equity. And consider that we have this decrease here. And again, I'm focusing largely on the US because the US it will be the main part of this declining asset turnover number, as the US is basically the developed world in the Western Hemisphere. But this asset turnover decline is with decades of inventory minimization still on board, but running its course. With wholesale manufacturing outsourcing, think of the iPhone to China, where only some design and engineering work is done in the States, but the entire manufacturing and increasingly all the components are also exported, the supplier base. So and the vertical integration obviously goes by the wayside. What does that mean? It means that asset turnovers are flattered because the sales that the American branded wares result in are, in an overstated sense, devoid of an asset base. And at the margin level, those cheap manufacturing sites that these companies either own in Asia or in Mexico or where have you, or outsource directly to third companies, those margins are also spectacular because the cost of goods sold and the salaries are lower, the compensation is lower in those outsourced emerging market locations. And that has benefited hugely both asset turnover and net margins. And both of these are running out of tarmac, right? But both of these, are especially the asset turnover, is going to be worsened if we get more inflationary pressure. That inflationary pressure, in turn, will be the result of primarily the dollar being increasingly rejected around the world, that causing dollars to come home. Foreigners, that's currently going on at the edges in China and in Russia and elsewhere, conducting bilateral trade outside of the dollar, deciding to take dollars and purchase real assets from oil to farmland and so on and so forth. If the dollar overseas come home more, or foreigners are convinced that the U.S. is just going to continue to debase its currency, print to repay its debt, that is either an inflationary issue or an insolvency issue if not enough is printed. And an inflation issue or currency debasement is nothing other than a piecemeal insolvency, because you lose capital or purchasing power when you convert it back into your home currency. So that development, if inflation really picks up, will balloon the asset base. Most especially, it will balloon the inventory as companies are forced to move from minimization of inventory, just-in-time inventory, to purchasing in advance in anticipation of rising prices, whether they're currency debasement, dollar decline based, or just the fact that there's substantial scarcity in various real assets that comes home to roost, or both. And then you will have a big issue because asset turnovers in the manufacturing arena is pretty well dominated by inventory levels, which instead of shrinking are going to go up, and with it, it's going to, together with potentially less outsourcing, place substantial sustained pressure on asset turnover, and thus on return on equity, and thus on profits and profit growth. Let me move to financial leverage, the third pillar. And again, these are the three main pillars. We could dissect the net margin at all levels, including down to the tax rate, or we could do the same for the asset turnover level, dissecting it to the inventory and the other main working capital components, the balance sheet, or we could do it for financial leverage even. But let's stick to the forest, the big picture, and focus on these three pillars and where they're heading or likely to head and why. And in so doing, let's consider the financial leverage. which again is the assets divided by the equity, or the balance sheet divided by the equity. And it's been rising, as you surely know, pretty much around the world. We've had bloating debt levels at the government, at the corporate, and in the US at the individual level, because consumers can't keep up without adding to debt. They're not earning enough. I mentioned that before. But corporations have been just paying out on debt thanks to financial repression, artificially low cost of money, cost of capital. If you look at the QE, it's cost of capital, cost of money is the artificially low interest rates, more commercial paper. But all in all, capital or money has never been so cheap. Corporations have pigged out on it. They've focused not on investment, on capex, on organic growth in the US, which is amply shown, proved, if you will, if you're looking for the proof in the pudding, by the expanding current account or net trade deficit numbers, which just continue to grow despite all the rhetoric from the Trump administration. They're expanding, not shrinking. And that is actually the report card that reflects America's product viability, America's product competitiveness, globally speaking. And I went into in other videos and posts that, it's the strong dollar. Oh, that's a lot of hooey. Germany and Japan long had very strong currencies and had large exports, and people blame mercantilism. But I blame I blame the US and its toxic public policies too. It's a homemade problem of taxation, litigation, and regulation insanity. $2 trillion a year just to buy off the bureaucrats. Talk about property right extortion going on. These are the issues that obviously have also led the C-suite into rationalizing stock buyback, shrinking their business instead of investing in it. But let's be frank, corporate chieftains, the C-suite top brass, have also found it incredibly lucrative to practice corporate anorexia. In other words, they get issued tons of options, stock options, that benefit not from what happens 5, 10 years down the road in one after another slew of competitive product launches that then help America reduce its trade deficit and benefit the most constituencies, including long-term shareholders, including employees, including the nation at large. Instead of focusing on that, they've gone after the fast buck. And we're talking about, tens of millions of dollars, and they've in essence get paid for corporate anorexia. That's just the truth. And that's been primarily where a lot of the debt increase has gone, is stock buybacks, and not into organic growth initiatives, no matter how hobbled those are by, yes, the too prevalent toxic public policies too. There are still companies that can get it done, and America has lower energy costs than other countries. So net, American enterprises should be able to produce competitive products, but they just aren't, because they don't have the incentive and the parallel interest to do so. But how does that relate to the financial leverage? Let me show you again from a similar source, this KL Capital, what's happened here with financial leverage. Again, these are developed market regions of the main economic blocks in the world: the Americas, the Western Hemisphere, the developed market. The kingpin there is obviously the US. So this blue line of rising sharp, substantial rise in financial leverage is captured here. And the other two regions are Europe, emerging markets, Africa. I'm sorry, Middle East and Africa. Again, that's in essence Europe. That's the red The red and the light blue is developed markets in Asia. But as this is an America-centric or U.S. corporate-centric display in terms of ROE, let me just take this trend here and extrapolate it and also build on it. Because what it means is that going forward, we're inevitably going to have deleveraging that's demanded. We've got corporations that are over indebted, that have been able to access credit in by non-traditional means, the shadow banking and hedge funds and yield-starved Japanese households and others have been more than happy in countries that have even lower yields, even more yield deprivation by savers that get screwed for the benefit of debtors that have purchased this. But what's going to happen going forward is that these companies whose bottom lines aren't what they should be, whose product portfolio competitiveness isn't what it should be, they're going to be forced to deleverage, whether it's by the creditors insisting on covenants being maintained or getting back into covenant alignment, or whether it's the market itself that forces it, or it's their cash flow and balance sheet. That is interest that gets difficult to service given crashing cash flow, especially in a recession. All these things will conspire at some point to reduce corporate leverage. That's what happens. The question is how? Well, one of the ways historically has been, and you probably guessed it, through the issuance, secondary offerings of stocks that have been retired, repurchased by greedy C-suite execs, already making tens of millions for destroying future product portfolios, that now have to come back to the market to increase the equity cushion of the business because creditors demand it, because their business plan requires it, because they can't get external financing anymore. So what they're going to end up doing is selling stock at half or a third of the value that they bought it back in, total value destruction. And that will come together, and here's the bottom line, to reduce corporate leverage, which, being one of the three pillars of the return on equity, reduce corporate leverage, and we're at a high point, means less return on equity for shareholders. And if we look at that corporate leverage or the increase in corporate debt, another chart courtesy of the Federal Reserve Board's internet site, Fred, corporate America has added $2.6 trillion since 2009 in debt. The total interest-bearing debt for corporate America has been tallied at over $6.2 trillion or $6.2 trillion as of Q3. And as I mentioned, this doesn't probably capture significant shadow banking related loans. It probably doesn't capture the off-balance sheet loans that are out there. So this, if anything, is going to be a lot worse. And when interest rates or the cost of financing and refinancing starts to creep up on such a huge debt burden, 6 trillion, probably 8 or 10 trillion, you're talking serious money, especially when juxtaposed against a massive hit to the P&L for the reasons already stated and the cash flow that is associated with it. So this is a serious burden and needs to be addressed. When we take a look at this in aggregate, and we look at net margins, we look at asset turnover, we look at financial leverage, and if I've convinced you that there's an argument to be made that all three of these pillars of equity, return on equity, the three component pillars, the main pillars, will be under certainly cyclical, recession-based, and I'm going to argue secular pressure as we continue to carry forward a toxic public policy stew pretty much around the world that is made for the benefit of creditors, made for the benefit of debtors instead of creditors. All right. Let's take a look. That's why we have all these debt mountains, and that's why we don't have interest rates that support capital formation. And with that, how can we hope to generate the competitive products of the future, especially not when management is incentivized to engage in de facto LBOing / corporate anorexia. But let's assume that we've got a cyclical decline in ROE that will be magnified by a secular decline. What we can look for are weak earnings per share and weak earnings per share growth. An imminent recession, I think, will bring this home to roost as shareholders realize the fragility of the earnings per share and then look at the underpinnings, or the underpinnings will work their magic rather, or the destructiveness on earnings power. We're talking about haircuts and return on equity. If we go back to the example at the outset, let me try to blind us in. Oh, first, let me make this comment. This is very important for historical perspective. EPS, if ROE can fall by 50%, earnings per share can fall by 50% or more, right? And remain depressed. The secular issues, our toxic public policies do. Our move away from a free market capitalism, sound money, property right protections, and all that other wonderful stuff, and instead the debt and the redistributionism, the cronyism, and the third world amnesty that has taken its place. But if earnings in a garden variety recession can fall by 50%, and an ROE in a similar magnitude, which explains the decline in earnings, then think about this as a preview of coming attractions, but I'm going to believe that we're going to see the next cycle on steroids because we have much more debt and we're deeper down the rabbit hole of the toxic public policy stew than we were 9 or 10 years ago. It took, as a for instance, in 2006, when Standard & Poor's 500 EPS peaked at $81.50 a share, it took 5 years to just barely exceed that number. And over a protracted period of time, despite all these bells and whistles and stock buybacks and all these other wonderful ill-conceived or management compensation centric value added schemes, what we've shown is EPS growth over long periods of time of about only 2.83% per annum, despite all these distractions and great propositions by senior management and stock buybacks and what have you. Moreover, the 5 years it took to best just barely the high watermark in 2006 of Standard & Poor's 500 EPS was preceded first by a reduction in EPS from 2006 over the ensuing 2 years of 82%. In other words, that 81.50 was first given a haircut of 82%, and then in the ensuing 3 years climbed back up. I think this time around we could see that and worse, as a lot of goodwill turned out to be bad will, and M&A, which is off the charts. People overpay, will end in tears, as it almost always does when management doesn't stick to its knitting, but majors in shock and awe. All right. Let's take a look at this from a mechanical perspective. We've got, again, the net divided by sales times sales divided by assets times assets divided by equity, our net margin times our asset turnover times our financial leverage. And in the example on the first page, I came up with a 14.3% ROE in a recession, in a stout recession. Given that costs can't be cut as rapidly as sales decline, if I predict a rather stout decline in sales of 6% from 100 to 94, again, thinking S&P 500 kind of number here, the index, then my profits are likely to fall by nearly half. Again, there's a lot of sticky fixed costs that you can't get rid of overnight, so profits really take a much stronger hit. So my 7% margin could easily go to 3.5%, 5%, 3.7%. My asset turns will also decrease with the sales decline on the one hand, and earnings that half of the $7 that I figured I would earn with the prior year's $49 in equity, the $49 times 14.3% gives me almost $7. I'm going to assume half of it I paid out in dividends, the other half I keep. That's going to bloat my asset total. I'm not going to take on any debt, not going to buy back any stock. I'm keeping half of those earnings. So my assets go up by $3 as well, or $3.50, excuse me, from 140 to 143.5, while the sales declines. That pushes down the asset turnover from 0.71 to 0.66. And we went over the leverage. That is also going to reflect a reduced leverage that results from ROE retention and the inability to take on more debt, in essence. So we go from 2.9 to 2.7 times. And if we multiply the stout recession ROE pillars together as a, for instance, as a possibility, and I think a very likely one, we end up with an ROE not of 14.3, but of 6.7, which generates not $7 in earnings per share, but something to on the order of half that, 350 or so. As a closing thought or two, or perhaps three, question: if the S&P at today's or yesterday's closing level of 2574, if that PE is looked at, and assuming that ROE gets cut in half, and assuming that EPS, S&P 500 EPS also gets cut in half, specifically from 130.39, these are GAAP numbers. You can get them directly off of the Dow Jones S&P site. We've got the trailing 12-month GAAP EPS, the S&P 500 of 130.39. If that was cut in half, in sync with the example I just made of a ROE being cut in half, earnings would come down to 65.20. And at a 2574 S&P index level, that would yield a PE of 39.4, which obviously can't be sustained for any time, especially not in an environment where ROE and profits threaten to unwind further, which usually happens, and in a world where interest rates are set to rise after a 37-year bull market. Why? Do I think we're looking straight into a bear bond market and rising interest rates and by extension rising discount rates? Don't forget, 10-year benchmark or the 30-year benchmark are the basis upon which future earnings per share are discounted back to the present. On top of that basis, on top of that benchmark is a premium. That premium is for greater risks that shareholders carry. Shareholders get no earnings, they have losses sometimes. Shareholders can get wiped out before bondholders do. So typically there is a risk premium, and we're seeing a lot of that in the widening spreads of corporate junk bonds over 10-year treasuries. And we're likely to see that on top of what I'm going to guess, no, not guess, and predict are much higher benchmark interest rates, much higher government bond yields in the so-called investment grade nations, as well as what we've already seen elsewhere. So this will together amount to a double-pronged or double hit on stock prices, coming from an EPS that is under much duress, could easily plummet by 50% or more. As stated, the reasons therefore, we went down 80% last time around and recovered only 5 years later. This time around, we've got a much worse situation to contend with, and we could even do worse than that. Well, if one considers the unprecedented global government solvency risks or insolvency threats, and at the same time the monetary inflation risks, meaning those governments will inevitably print even more money to try to sustain the unsustainable. So they either get insolvency if they can't print their own money, those countries that can't, or you get a monetary inflation-based de facto insolvency. Your money is only loses tremendously in terms of its purchasing power. So both of those things suggest that creditors or bond vigilantes will come riding back into the middle of the economic or financial stage to demand higher interest rates, which in turn will yield a 1-2 punch in terms of equity valuations in PE terms, in stock price terms. These things are not academic. This is what the future holds, and history repeats. And my predictions here are based on hopefully a solid grasp of cycles and of finances, and also a sense of history and some sane extrapolations into the future given where we're at. So let's make it, for instance, let's say the S&P 500 only earns $100 a share and not the 131 or 130 that we have over the last 12 months. Why, that would be the equivalent of, if it's capitalized at the average 16 multiple, a 38% reduction. A 1600 S&P 500 level would amount to a 38% reduction. If we assumed that the S&P still earned $100 a share, not the 65 that I think we're going to, and we attach a multiple of only 10 times because interest rates and discount rates are going way up, then we're looking at a 61% market implosion. That is, the S&P 500 would fall by 61%. Recall, if you will, that markets are not reversion to the mean machines. They are reversion beyond the machine, beyond the mean machines. They are boom, bust, bust, boom. Currently, we're at boom levels. I think we got a long-term bust ahead of us. And I think it will prove very lengthy given the deep crap that we are in, the antithesis of free market capitalism and sound money. By the way, sources here for the index, if anyone has any interest, the S&P 500 index is the address where you can go and open up the 12-month GAAP earnings per share yourself that I got here of 130.39 is right there. If we marry lower earnings power, lower EPS, thanks to a step down in ROE as all three of our pillars threaten to get whacked substantially uh, in a secular sense. Also, given the high watermarks they're at. Net margin, that's going up courtesy of corporate income exceeding gross domestic income growth, asset turns being flattered by a lot of outsourcing and relatively cheap materials costs, and financial leverage ramping up thanks to financial repression, that is exceedingly inexpensive borrowing costs. So we're not just going to see a reversion from these excessive uh, ratios, but we're going to get a drubbing thanks to the terrible situation that we're in financially, economically, financially debt, economically productivity, and politically we've lost the rule of law and property right protections. So this is going to aggravate this whole thing. And that's why I think we're going to see an even more pronounced reversion beyond the mean machine market on display, both in bonds and in stocks. And do recall that bonds and stocks are tied at the hip. Specifically, stocks, I go into great depth in post 25 and I believe in post 37, but definitely post 25. Have a look if you're so inclined. I linked to that here too in the slides that I've prepared. What you're going to find is that bonds and stocks travel together. They're joined at the hip. This is displayed by earnings yields, which are PEs flipped on their head. If you have an earnings yield of 15 in 80-81, when you have a PE of 6.7. And interestingly, investors seek relatively similar kinds of yields in terms of earnings yields, an EP, if you will, as they do bond yields. And we're now, as you know, near the end of a 37-year bull market in stocks, PE expansions furthered by a 37% or 37-year bull run in bonds that have brought us to these insanely low yields, which were furthered by financial repression for the last 10 years. But here's the potential carnage ahead. This is courtesy of, this is using Yardeni research. And what this chart shows is the blue line are the earnings yields, flip PEs or EPs. Red lines are 10-year treasury. In 81 and 80, they peaked. We had earnings yields of 15, PEs of 6.7, which accompanied 10-year and 30-year treasuries also yielding approximately 15% in the third quarter or in late 1981. And since then, we've had this huge expansion in PE multiplies enabled by progressively lower interest rates. This will come to an end, and we will have bargains as the bond bear market gets underway, thanks both to solvency and monetary inflation risks. So the takeaway here is sell if you have overvalued bonds and stocks for both ROE compression of both cyclical and secular nature, and because whatever earnings EPS corporations can get is going to be worth less in an era of rising, not falling interest rates. This does not apply, by the way, for those persons that have blue chip stocks, the Johnson and Johnsons of the world, the Nestle's and their ilk that were purchased 30, 40 years ago, right? Where they have locked in an earnings yield of 15 or even more, and are probably getting up to a mid-teens dividend yield thanks to locking in very low purchase prices. Thanks for tuning in, and hope you find this of use. That's it from here. It's Dan Kerr's DK Analytics. It is January 9th, 2019. Bye-bye.